Over the last 20 years, 92.89% of professional fund managers, the people paid millions of dollars to pick stocks for a living, failed to beat a simple S&P 500 index fund, and that number comes straight from the S&P Dow Jones Indices scorecard measured through the end of 2020. In the next few minutes, I'm going to explain exactly what an index fund is, why it quietly outperforms almost everyone on Wall Street, and how you actually buy one. If investing has ever felt like an intimidating club you weren't invited to, stick around because by the end of this video, you'll understand something most people never learn. Let's start with the simplest possible definition. An index fund is a basket of stocks that mirrors a market index, like the S&P 500, which is just the 500 largest companies in the United States. Rather than trying to guess which single company will become the next Apple or the next Nvidia, you buy a tiny slice of all of them in one single purchase, which means you aren't betting on a winner, you're quietly buying the entire game. Picture it this way. If active stock picking is trying to predict which horse will win the race, an index fund is owning a small piece of every horse on the track, and when somebody crosses the finish line first, you already own them. This whole idea traces back to a man named Jack Bogle. Back in 1951, Bogle wrote his senior thesis at Princeton and found that most mutual funds did not beat the broad market once you accounted for their fees, and he spent the next 25 years thinking about that problem. On May 1st, 1975, Bogle founded a company called Vanguard, and on August 31st, 1976, Vanguard launched the first index investment trust, the first index fund ever made available to regular people. The launch was a disaster. Bogle had hoped to raise $150 million, and he raised just $11.3 million, which is why the investment bankers told him to cancel the fund, and his exact response was, quote, "I said, hell no." Critics called it Bogle's folly. The chairman of Fidelity at the time put it this way, quote, "I can't believe that the great mass of investors are going to be satisfied with just receiving average returns. The name of the game is to be the best." He was wrong, spectacularly wrong, because here's the thing. Bogle understood that almost nobody else did in that era. In investing, average turns out to be extraordinary. Every year, a company called S&P Dow Jones Indices publishes something called the SPIVA scorecard, which stands for S&P Indices versus Active, and it tracks how professional fund managers, the ones with MBAs and Bloomberg terminals and teams of analysts, perform against a plain, boring index fund. The most recent scorecard, published for year-end 2025, tells a brutal story. Over 1 year, 78% of large-cap active fund managers underperformed the S&P 500, and over 5 years, nearly 89% underperformed, and over 10 years, 85% failed to beat the index. Stretch that window out to 15 years, and it climbs to around 90%, and over 20 years, 92.89% of them lost to a fund that does absolutely nothing but track the market. Zoom out to all domestic stock funds compared against the broader S&P Composite 1500, and the 20-year underperformance rate climbs all the way to 95%. Here's the detail that genuinely shocked me when I first saw it. Over 20 years, roughly 2/3 of domestic stock funds didn't just underperform, they got merged or liquidated, which means they simply disappeared, and only about 36.5% of domestic funds even survived a 20-year period. When somebody promises they're going to invest your money and beat the market, the base rate of that claim actually working out over the course of your career sits somewhere between 5 and 10%. Why does this happen, and why can't these smart, well-paid people just beat a simple index? The answer comes down to two things, and the first one is pure arithmetic. In 1991, Nobel laureate William Sharpe wrote a short paper called The Arithmetic of Active Management, and he proved something that's basically impossible to argue with. Before costs, all the active money in the market added up together has to equal the average return of the market, because collectively those active investors basically are the market, which means that after you subtract their fees, the average active dollar has to earn less than the average passive dollar. That isn't a theory, it's math. The second reason is fees, and this is the part that quietly destroys more wealth than almost anything else in personal finance. So I need you to really sit with this for a moment. When you buy a fund, it charges something called an expense ratio, which is the annual fee, expressed as a percentage of your money, that the fund takes every year simply for existing, and you never receive a bill because that fee is silently deducted from your returns. The asset-weighted average expense ratio for passive index funds sits at roughly 0.11%, while for active funds, it's 0.59%, which sounds like a tiny difference. A fraction of a percent, the kind of number that seems barely worth caring about. Here's why it matters enormously. The U.S. Department of Labor publishes an official example of how fees affect retirement savings. Picture a $25,000 account left alone for 35 years, assuming a 7% average annual return. At a 0.5% fee, you end up with $227,000, and at a 1.5% fee, you end up with $163,000, which means that 1% difference in fees reduces your account balance at retirement by 28%, and those are the Department of Labor's exact words. Let me frame that another way. Invest $100,000 for 30 years at a 7% return, and the difference between paying a 0.04% index fund fee and a 1% active fund fee works out to about $178,000. That's not $178, and it's not $1,700, it's $178,000, roughly 31% of your entire ending balance, quietly transferred from your retirement to somebody else's bonus. This is exactly what Jack Bogle meant when he wrote, quote, "Investors need to understand not only the magic of compounding long-term returns, but the tyranny of compounding costs that ultimately overwhelm that magic." Even Warren Buffett, arguably the greatest stock picker who has ever lived, tells regular people not to try to be him. Back in 2007, Buffett publicly bet $1 million that a simple S&P 500 index fund would beat any 5 hedge funds a professional could pick over a 10-year window, and a hedge fund manager named Ted Sides took the bet. They ran it from January 2008 through December 2017, and the result was lopsided. The Vanguard S&P 500 Index Fund returned 125.8%, while the average of the 5 hand-picked hedge funds returned about 36%, and Sides conceded early with these words, quote, "For all intents and purposes, the game is over. I lost." In his 2013 letter to Berkshire Hathaway shareholders, Buffett went even further and told the world what's written into his own will. When he dies, the cash he leaves behind for his wife goes into a trust with very specific instructions, and I'm quoting him directly, quote, "Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund." I suggest Vanguard's. The greatest investor alive is telling his own wife to just buy the index. Now you're probably thinking, fine, I'm convinced. How do I actually do this? So let's walk through it. You'll generally choose between 3 types of index funds. An S&P 500 fund holds the 500 largest U.S. companies, which is about 80% of the total U.S. stock market. A total stock market fund holds everything: large, mid, small, and micro-cap U.S. stocks, usually somewhere between 3,500 and 5,000 companies. A total international fund holds stocks outside the United States, covering both developed countries like Japan and the UK, and emerging markets like India and Brazil. All 3 of the big providers offer excellent versions, and the expense ratios are almost unbelievably low. At Vanguard, you've got VTSAX, or the ETF version VTI for the total U.S. market, at 0.04 and 0.03%, along with VFEAX or VOO for the S&P 500, also at 0.04 and 0.03, and VTIX or VXUS for total international at 0.09 and 0.05%. Over at Fidelity, FXIX tracks the S&P 500 at just 0.015%. FSKX is their total market fund at that same 0.015. And VESROX is their zero-fee total market fund with a literal 0.00% expense ratio, which Fidelity launched in August 2018 as the first zero-fee index fund in history. Schwab offers SWPPX tracking the S&P 500 at 0.02%, and SWTSX is their total market fund at 0.03. One quick heads up about Schwab's international fund, SwissX. which only covers developed markets, meaning it skips China, India, and Brazil. So if you want full international exposure, Vanguard's VXUS or Fidelity's FTIHX will give you broader coverage. Every one of these is functionally an excellent choice, and the difference between a 0.015% fee and a 0.04% fee on your portfolio is not what determines whether you retire comfortably, because what actually determines that outcome is simply that you start and keep going. Which brings me to the strategy you use to actually invest in these funds, and it's called dollar cost averaging. And it's almost insultingly simple. You invest the same dollar amount on a regular schedule, no matter what the market happens to be doing. So when prices are high, your fixed amount buys fewer shares, and when prices are low, that same amount buys more. You don't try to time the market. You don't wait for the perfect moment. You just keep buying every paycheck, every month, indefinitely. Let me be honest with you, though, because the research here is genuinely interesting. Vanguard has studied this question carefully, and if you happen to have a large lump sum sitting in cash today, the data actually shows that investing it all at once beats dollar cost averaging about 2/3 of the time, but almost nobody reading this is actually in that situation. Most of us invest out of our paychecks, a little at a time, and in that normal scenario, dollar cost averaging isn't really a strategy you consciously choose, it's just how real life works. The biggest benefit isn't mathematical, it's psychological, because it keeps you in the market when things get scary, and things will absolutely get scary. Let me put some perspective on that. Going all the way back to 1928, the S&P 500 has averaged roughly 10% per year nominally, or about 7% after you account for inflation. Across 97 years of data, the market has finished positive in 71 of them and negative in 26. Which works out to positive about 73% of the time. $100 invested in the S&P 500 at the start of 1928 grew to roughly $982,000 by the end of 2024, and yes, that number already includes the Great Depression, World War II, the inflation of the 1970s, Black Monday in 1987, the dot-com bust, the 2008 financial crisis, and COVID. Speaking of those crashes, in 2020 when COVID hit, the market fell 34% and then fully recovered in about 5 months. The 2008 financial crisis was considerably worse, a 56% drop, and it took roughly 4 years to fully recover. Hartford Funds looked at the 10 worst single-day drops in S&P 500 history, and 1 year later, the index was up double digits in all but one of them, which tells you everything you need to know. Markets fall, markets recover, and the people who win are the ones who kept buying while everyone else was panicking. This is why Bogle said, and I love this line, quote, "Don't look for the needle in the haystack. Just buy the haystack." Let me pull this all together. An index fund is a basket that holds hundreds or thousands of stocks at once, designed to match the market instead of beat it. Over 20 years, more than 92% of professional fund managers fail to beat it, and most of their funds don't even survive. The fees on index funds are a tiny fraction of what active funds charge, and that tiny fraction, compounded across an entire career, can mean the difference between a comfortable retirement and a stressful one. The richest investors in the world, including Warren Buffett, tell regular people to buy index funds, and Buffett is personally putting 90% of his own wife's inheritance into one. You can open an account at Vanguard, Fidelity, or Schwab, pick a total market or S&P 500 fund, and start buying the same amount every single month indefinitely. That's the whole strategy. It isn't clever, it isn't exciting, and it definitely isn't something you'd pay 1% a year for a Wall Street manager to execute, because the entire point is that you don't need one. Here's what I want you to take away from this video. Most people spend their entire lives thinking investing is something for other people, for smarter people, and richer people, and people who somehow have a secret the rest of us don't. But the actual secret, the one pointed to by 25 years of SPIVA data and by Warren Buffett's own will, is that the boring answer is the right answer. Consistent, low-cost, passive investing in a diversified index fund quietly beats almost every expensive strategy on Wall Street, not sometimes, but over and over and over again. You don't need to be smart, you don't need to be lucky, you just need to start, keep your costs low, and refuse to panic when things get ugly. You now understand something that most people never figure out, and the only question left is what you're going to do with it.